Today I'm talking about Confluent, a stock which the market I think is underappreciating at the moment given its potential massive tailwinds in the next stage of AI. The shares had a really good IPO in 2021, they raised a lot of money, and since the crash in 2022 they've been trading in a range between about $20 and $35 per share. Now since then Confluent has posted very good sustained revenue growth. They're now in the range of 20 to 25%, and thus that has pulled the forward price to sales multiple down to about 7. So they're trading a pretty good value relative to where they've traded at before. Now, what caught my eye about Confluent is, in effect, they build data pipelines to flow data through different sources. Now, the key use case for this is in real time, because traditionally an organization obviously transfers data in big batches from one place to another. But Confluent effectively builds, think of it as pipes, right? Like non-physical pipes between different data sources, so companies can have that data flowing in real time. And this actually is extremely necessary in an age of agentic AI and Internet of Things, where you've got AI models having to make decisions in real time, and for web pages or messages to be updated and reactive based off data, because that data needs to flow through an AI model, because that data needs to flow and thus be updated in real time in order for smart decision making to occur with those AI agents. One massive example of this actually is in banking. So for instance, Confluent would be used, let's say someone is making a series of transactions and the bank is looking at various factors as to highlight how likely this is going to be fraud. Confluent will enable that data to be flowed from that page into a model that would actually predict, oh, this is likely to be a fraud, this is not likely to be a fraud. Do we send our customer a warning message? Do we stop the transaction altogether to protect their money? What exactly do we do? And in order for artificial intelligence to autonomously make that decision, data needs to be flowing through, but because AI needs to act off that data autonomously, it's like a constant, very light inference that is not just based off a pre-existing data set like a traditional ChatGPT is. Like ChatGPT or a large language model is an encyclopedia that does get trained on additional data and becomes smarter when it's batch trained. But for certain use cases that are time sensitive, companies need to react in real time. And that's where you need a data pipeline, which is what Confluent helps enable. Another example is obviously in the Internet of Things market, when you have smart devices that need to react in real time. A massive example at the moment with Tesla launching in Austin is full self-driving. Obviously that data needs to flow from the car to the model, back to the car needs to make a decision. That is exactly what a data pipeline will be used for. It's less about AI actually acting in the background and then you looking something up off a pre-trained neural net. These new agentic AI actually has to make a decision in real time, and that is really what these data pipelines are useful for. So it is very true that some of these companies are going to build their own data infrastructure, right? A classic example of that is Uber. So Uber used to be a massive user of something called Apache Kafka, which is what Confluent is built upon, since they've created their own data pipelines, which extremely large companies are probably incentivized to do because they actually have the scale to be able to do it, and thus it's more cost effective for them. Uber, for example, if I order something on Uber, Uber wants to react to that data in real time by saying, oh, would you like to bundle together XYZ items that is at this store that your delivery driver will pass on the way? I'm talking about delivery, obviously, not mobility. Or it could be mobility. If my driver is coming and he wants to grab me a snack on the way, like you'll say, okay, do you want this food? Like H usually eats this food, and they will update. They need that data to flow in real time because they need that AI agent to react to the current data that I have just said, oh, I'm riding from A to B, or I've ordered a Thai food, and usually with Thai food, I ordered lemonade, and this Thai restaurant doesn't sell lemonade, but there's this other like 7-Eleven on the way. So the Uber rider can like stop at the 7-Eleven and pick up my lemonade. That's exactly what you would need a data pipeline for. So I mentioned that Confluent is built off Apache Kafka, and that is an open source data platform. It's the most widely regarded and widely used. Now, the founder or the founders of that, two of them, including the CEO of Confluent, that founded Confluent and Apache Kafka, they actually founded Apache Kafka. So the founders of Apache Kafka also founded Confluent to effectively monetize it and make Apache Kafka extremely easy and straightforward to use. So Apache Kafka is the basic infrastructure, but Confluent is the software and the tools that actually enable enterprises to use Apache Kafka. And as we segue from a world where, yes, we've got large language models just providing us information and being the brains, we're going to move towards a world where AI starts to act autonomously, both in the physical world, for example, with full self-driving cars and other smart devices, and then also in the digital world, where it's actually clicking those buttons and reloading those web pages and effectively smart pricing, personalized recommendations, etc. If anything that is time critical, it's not going to be based off batch processing. We're going to need that data to flow in real time. And that is exactly what Confluent enable. Now, of course, the big tech guys do this too. It sounds like a big market, what I'm talking about, and that doesn't come without its competition. So one risk when you're looking at a company like Confluent is whenever there's a big market, of course, the hyperscalers will go after it too. So all of Microsoft and Google and Amazon, they all have their own tools built off Apache Kafka or the other data infrastructure flowing companies. And they have the products. Now, what I would say to that, I can see on the reviews, at least on g2.com, that Confluent has the highest sample size of reviews, and it's suggested that Confluent is largely the market leader with live data flows. We can see that Azure's product has 4.2 stars and 13 reviews. Amazon's has 4.0 and 21 reviews. Google's actually looks much better with 4.6 and 54 reviews. Confluent's got the most with 111 reviews and 4.4 stars. So Google seems like the most, at least based off reviews and satisfaction, the biggest kind of competitor or the biggest potential threat to Confluent. And you obviously you worry about this whenever you're investing in a small company, because Confluent, they are just under 1 billion in annual revenue run rate right now. You worry that, yes, when you've got a company that's not really making that much revenue, they're putting a few $100 million a year into R&D, that a big tech company can come and destroy them. But one thing that I do think gives Confluent a bit of protection is Jay Krebs is there running Confluent, and he founded Apache Kafka. So he is a real expert in this niche and in this industry. So that clearly gives Confluent a massive advantage. And they have actually had some really good growth. So it's for the last 6 quarters or so, Confluent's rate of revenue growth has not really slowed down that much and actually re-accelerated last quarter. So that's very promising. You can see a wonderful quarterly revenue graph here, which is up and to the right, very consistent. So great growth there. But what's really interesting for Confluent, and this is a key point, is you can see here, this is the number of total customers reported by quarter. And over the last few quarters, so you've got total customers in dark blue, and in the lighter blue, you've got growth in total customers. Growth in total customers has started to re-accelerate and is now at 20% a year. So they're growing their total baseline customers at 20% a year, but they're also growing their expand. So they're growing their land, but they're also growing their expands. You can see high-end customers that are spending a lot and Confluent is accelerating nicely. Customers with 1 million in ARR, that grew 25% last year from 168 to 210. And a real acceleration on the quarter there for high-end customers. But another reason why this is important is Confluent operate a consumption-based model. So i.e., instead of a subscription per person or per company, users are paying for what they use. And of course, that gives Confluent more risk, but a tremendous amount of upside if agentic AI takes off quickly, which I think it will. That's the phase that we're moving towards, smarter AI. Then Confluent as a consumption-based model has the potential to grow absolutely exponentially. And when you've got your baseline level of customers growing at 20%, obviously consumption-based revenue does extremely well on expand. So it's great to see the reacceleration in revenue for total customers. And this is the thing with just how good the hyperscalers AI and OpenAI and all of these other companies that aren't hyperscalers or AI pure plays, they are going to have to use AI effectively to stay ahead. ChatGPT versus Duolingo is a prime example of this. And in order for companies to effectively use the data that they've got, they're going to need to maximize revenue in real time and maximize customer experience. And they're going to do that by turning their platforms from just pre-existing code and pre-existing software that's static to constantly be updating and reacting to getting the most from the customer and also enhancing their customer experience. And data pipelines, where you have data live streaming and agentic AI to be able to react off that, is going to be a massive thing that companies will have to use if they want to stay ahead of the game. So I think once you get up to a point where like 10 or 20% of non-specialized AI companies are actually starting to utilize agentic AI, then it's a tipping point where other companies will start to race, because they realize if they're not doing this, if you have platform A that's smart and platform B that's dumb, you're still going to tend towards platform A. And that is a massive goldmine of revenue for Confluent. As I said, it's a pure play in this industry, and with such a big total addressable market, with the market leader, obviously the hyperscalers have got their own solutions, but also with Jay Krebs at the helm, who founded Apache Kafka himself and knows a whole load about this niche, there is a very, very big total addressable market there. So I mentioned that the company trades at a forward price of sales of about 7, and it's bouncing within a range of about $20 to $35, which is also an interesting technical play. I don't think that Confluent, particularly based off, forward price of sales of 7, enterprise value to gross profit or market cap to gross profit, I like to use these metrics as well, currently 11.8 based off the last annual gross profit. I think that the probability of them getting to below $20, which would be, so they're currently at 25, so that would be verging on 8.5 times, 9 times market cap to gross profit, 5.5, 6 times forward sales. That is a pretty low ratio if things continue to go well for Confluent. As I said, their revenue is kind of in this 20 to 25% range. They forecasted for 20% for the full year. We'll see how that goes in coming quarters. And as I said, I think in between about 2026 and 2028, this could start to be a tipping point for agentic AI. And if Confluent capitalize on that correctly, there are obviously major tailwinds, major tailwinds. So it's interesting to see them in that range. And I think the catalyst out the range would obviously be that revenue reacceleration growth. If Confluent is able to capitalize on helping organizations build these live data pipelines, making it extremely easy, because that's the other thing, is that if AI is moving so fast, then organizations that aren't extremely massive with the resources to build and code all of these data pipelines themselves and make sure their data is flowing seamlessly, they will come to a company like Confluent for that solution, because they realize that in order to stay ahead of the game, they're going to need smart AI integrated into their business. Now, what about the risks and the weaknesses of Confluent? Obviously, there's hyperscaler risk. And the thing is about hyperscaler is, these guys can basically, there's such a large total addressable market, they can bundle in this no code service for data streaming in with their existing products, their existing suites. It's a Microsoft, Google, Amazon classic, right? And that could be a disruptor to Confluent. So it's certainly worth watching what people are saying about all of the different products. As I said, it's positive that Confluent have at least better reviews than Microsoft and Amazon, and also more reviews than pretty much all three of them put together, at least on G2.com. So that's positive. But one of the issues is that Confluent not having that massive ecosystem. You can see here, they're spending 42% of their revenue, at least for Q4 24, on sales and marketing. So that's a whole bunch. And when you add that to the R&D, which is an appropriate level of R&D for a company like Confluent, I like the fact they're spending a lot on R&D. G&A is extremely efficient, at least. Then, of course, Confluent are not making large profits. Their profitability is getting better, but they're not in that stage yet. And this is another thing, actually. Have a look at this. So I've put together a table of companies that are similar to Confluent, both in the industry they operate in, their market caps, and also actually their growth. So we've got software and computer companies here with market caps between 5 and 17 billion, growing between 17 and 30% per year. So here's Confluent trading at 12 times enterprise value to gross profit. So cheaper than a lot of these names. But what you can see is, combined with them not making a net profit, stock-based compensation is extremely excessive. 41.1% of turnover at the moment. That is very, very, very high. So that's something to watch. And of course, what does stock-based comp result in, particularly when companies are not breaking even or not optimized on net profit? A lot of share dilution. So compared to most of these names, this is number of shares versus number of shares 2 years ago. Confluent have had 15% dilution within those 2 years. And I've compared it to these companies to put it into context, because 15% dilution for a much larger company would be insane, but for a small growth company that's actually rewarding top talent, etc., you would expect some dilution. But you can see that for companies with similar metrics, Confluent share dilution is still extremely high, higher than Sentinel One, and considerably higher than all of the others. Let's just have a look at that. So here is the total stock-based compensation. So you can see that has increased steadily. It decreased for one of the first occasions on the last quarter. And if we highlight that growth out, I mean, stock-based comp has been, growing quite fast. That's the thing, is that it's been growing slightly slower than revenue over the past couple of years, but not excessively. And I think really, in order to minimize that risk, I would like to see at least stock-based comp growing at less than 5% a year. If we turn that to what really matters, because what we're talking about with stock-based comp is obviously what that results in, it is shares being diluted. So your piece of the pie as an investor that you own shrinks and shrinks and shrinks. And this is Confluent shares outstanding over the last few years. So the range is between 6 and 8%, and it's kind of been quite stable in that range of dilution, and it's been ticking up for the past couple of quarters. Dilution between 6 and 8% is quite high when your revenue growth is forecasted to be 20%. That's a third. That's a third of your revenue growth. So that is something that makes me hesitant, or actually just is a big bear thing for Confluent, is they really, really need to segue themselves towards profitability. It is positive because they broke even on free cash flow for the first time last year, generating 9.5 million in free cash flow, and their net profit margins have improved. They're getting less negative, but they really need to hit that profitability inflection point. And I think then the market will be a bit more giving, and they will assign a higher multiple, because if you're growing your revenue at 20%, and Sarita's Paribus, the margins stay the same, and the multiple on revenue stays the same, the stock should sort of follow a 20% growth pattern, right? Leaving out an infinity of factors, growth helps the stock price go up. But then if you're getting 7% on average annual dilution, that then brings that return down to 13%. And then all of a sudden you say, okay, at 13% revenue growth, that forward price to sales of 7, or that enterprise value or market cap over gross profit of 12 doesn't actually look particularly cheap. And I know it's not cheap anyway, but I'm talking cheap relative to the growth company. So what really becomes interesting for Confluent is if they can do a few things, if they can re-accelerate their revenue, hold fire, but if they can re-accelerate their revenue as we move into the age of agentic AI, they can remain that market leader on live data streaming. They can also reach that profitability inflection point, so they're not having to make a loss. And because you've got the double whammy of diluting shares, you've got the loss because they're having to do high sales and marketing, high R&D, etc., and stock-based comp. If they can reach that profitability inflection point without compromising on their growth and have the re-acceleration from agentic AI, bring that stock-based comp down a percentage of revenue over time, then I think that's when they break the $35 range and there's a lot of upside. But that could be a couple of years away. That really could be, because they've got a few things to fall in place. And I think then the risk where they go below 20-ish bucks a share, where they've bottomed out, Yeah, it's closer to about 18. They've sort of bottomed out at 18, which is 25% downside from the current share price of $24. I think they go below 18 if they're not able to get that stock-based comp down, they're not able to get that spending down, but then they report like 18% revenue growth this year, so they have a miss on what they're forecasting, and then they forecast 14-15% for the next year, and it's clear that Confluent isn't going to be a leader in data streaming, which is obviously critical for agentic AI and smart devices, etc. Then that is where they could fall below that $18 share price and basically get stuck there until someone comes in and revitalizes the company. But the good news is it looks like they're the market leader in what is a very, very difficult thing to do, where Jay Krebs is an expert. As I said, that's a real big plus for the thesis that the founders of Apache Kafka are there running Confluent because they understand this problem better than anybody else. And as I said, all companies are going to need to get smart. And the vast majority of them are not going to have the time or resources, just the time to be able to use an open source product to build out all of their own data infrastructure, particularly as it gets extremely complex. And many of them, as I said, they're going to need live data as AI gets smart. And that's what Confluent is going to be here for. And then also they can get into that market cap range of 15, 20 billion. Then it's just Wall Street gets a bit more interested at that level. An $8 billion company, a $25 stock, a stock that's never really gone up, really. It's kind of gone up and then just gone back down. The stock doesn't look nice. I think when it breaks $35 and starts to go up and prove that it can break out, then you'll have Wall Street get interested. If it's a double from here, then it starts to get into, do I qualify for the NASDAQ 100 territory? So Confluent could have a really good few years ahead of it if they get things right. We'll see, but in my opinion, they are very, very well positioned to be a picks and shovels play as we move towards the age of agentic artificial intelligence.